Okay, hey everyone, part 3 in the series on trusts. We've done some theory in part 1 and 2. I just want to give you a practical example of how this can save a bit of tax and how the tax works and flows through the trust. Again, quick disclaimer, tax, legal, credit advice, go and get it before you do anything. Let's think about a very simple trust structure where the trust is just being a passive investor. Let's just say, for example, you've inherited some money and you want to put it to use in a trust, and that trust is going to go and invest in things like term deposits, shares, property, those sorts of things. And for this example, let's just say you've got a share portfolio of stocks on the ASX or maybe international shares as well. In this example, we've got $50,000 worth of investment income coming in annually, so dividends, rent, interest. Okay. Now, the trust is a flow-through entity, and what that means is it doesn't pay tax itself. It can in some circumstances, but it would pay the highest rates. It would pay top rate, 45%. You only end up paying tax in the trust typically if something's gone wrong. Ideally, it flows through the trust to the beneficiaries, okay? In this example, we've got two beneficiaries, John and Jane, and we're saying they're husband and wife. John is acting as the trustee and the appointer and is also a beneficiary, and Jane is a beneficiary as well. And so, for example here, that $50,000, we can split that however we want between John and Jane. And that's the whole point of being a discretionary trust. Every year we can change it. So for example, we can give $10,000 to John and $50,000 to Jane. Now, why would we want to change these around? Typically, the easiest way to think about this is to think about our tax rates and our existing income levels. Quick refresher on our tax rates. First $18,000 tax-free. The next bracket up to $45,000, we pay 16% tax. The next bracket up to $135,000, we pay 30% tax. Then up to $190,000, we're paying 37%, and over $190,000, we're paying 45% tax. And now remember, we have to add on the Medicare levy surcharge to all of these numbers. So the top rate is really 47% tax, okay, almost half. So you can probably see where this is useful. If John is the main income earner and he's earning $190,000, every single additional dollar that he earns, 47% of it goes to the tax man. Jane, let's just pretend Jane is a stay-at-home mum, and she might have some part-time work, but her income is much lower than John's. We can use up her lower income brackets by distributing profit to Jane. Okay, so let's just think about a scenario where that's the case, as we just discussed, and we're going to give the full $50,000 to Jane. And I've just done a little bit of basic maths here to compare the scenarios. Okay, so scenario 1, we don't have the trust, we haven't set it up, and all the shares have been invested purely in John's name. He's already earning $190,000. While Jane is earning $25,000, okay? If we give the full 50 to John, his additional tax on that 50 is just over $25,000, which is about 47%, and it's a little bit extra in this case because he gets lumped with this other tax called Division 293, which is an extra tax on his super for anyone who earns over $250,000, including their super. We're not going to go into that in detail, but basically it means he pays the 47% plus a bit extra as well. You can see it's more than half. Okay, so in scenario 1, this is the worst scenario. We are paying $25,000 worth of tax on $50,000. Now scenario 2, this could just be a 50-50% split between John and Jane, and you might just do that by investing the funds in joint names, and you could do that without a trust. Okay, so a basic example would be if you had a term deposit and you were both account holders on that term deposit, you would both get taxed on half of the interest each. So this is better than doing nothing. In this case, the 50,000 is split equally between John and Jane. John still pays a lot of tax, and Jane is still paying some as well. And the total tax is about 18,000 compared to the 25. So we're still, we're still 7.5 grand better off by doing that. Okay. Scenario 3, we are using the trust. This is what we're doing. So we're not giving any to John, we're giving the full 50 to Jane, and she's going to pay 14 grand tax. And so here we're comparing 14 grand tax to 25 grand tax. $11,000 better off, okay? Now that's just in year 1. Have a think about what would happen over 5 years, 10 years, 20 years. Those tax savings each and every year are going to continue, so long as we keep investing and using the trust. And then the other thing to think about is actually the compounding effect. I mean, you've just saved $11,000, so you can then go and reinvest that in more shares or whatever more property, whatever you're doing. And year after year, that will compound and compound and compound. And so the tax savings are only going to grow and grow and grow as your wealth grows. Okay, hopefully that makes sense. This is a pretty basic example. There are plenty other ways to think about this. For example, if John and Jane had children who were approaching adulthood and maybe they were recently 18 or 19, 20 and they went off to university, and let's just say John and Jane were paying their college fees or their dorm fees or helping them with rent, living costs while they were away studying. In that case, you could probably distribute some income to the kids, and if they were only working part-time, you would again get a very good tax outcome. There are some rules around that we have to be particularly tricky of. There's a part of the law called Section 100A that can come into play when we distribute the money to the kids on paper, but we don't actually give them the cash. We take the cash, okay? And so sometimes you can get into sort of risky territory there. Happy to talk at length about that, and I might do that in another video. But that's one example. Another example might be where, let's just say John and Jane are actually running a business here, and they're both, we've sort of capped out both of their income brackets, and they're both at 150 or 190. They're both high income earners, and so everything else that goes to them is being taxed at 47%. One thing we could do in that situation is actually add a bucket company to the structure. And once we get to that point, there's really strong profits in the business, you've built it up over the years, we could actually distribute profits from the trust into another entity, a bucket company, and that would pay tax at 30% instead of paying tax at 47%, okay? That's another pretty common example. And then within that bucket company, you could, again, invest in shares, fixed interest. You could invest in property. Some people like to do property developments within a bucket company, so they might buy a block and knock it down and rebuild it, or subdivide or build a duplex or anything like that. And sometimes for high income earners, doing that in a separate bucket company is a great strategy. And again, the trust allows for that. So the key thing to remember is the flexibility that this enables, okay? We can change these figures every year to suit us best. And that is the unique thing about a discretionary trust. Hopefully this makes sense and makes it clear that there is considerable benefit to be had here. We always have to think about the costs as well. There are some accounting fees to come into it, but when you look at the numbers and do the math, and you've got a decent chunk of money, maybe it's that inheritance, this is worthwhile doing for some people. Next video, I'm going to go into a calculator that I've built for some clients in the past, and I can share with you, and it will just sort of demonstrate what happens when we do think about those longer time horizons, 5 years, 10 years, 20 years, and the compounding effect that trust can have. So I'll see you in the next one. Thanks, guys.